Hello, everyone. Welcome to this financial planning masterclass. I am Blagoy Hamamjiev, and I'm the founder and CEO of Modeliks, a business planning software for small businesses and startups. Today, we are going to talk about the financial planning process. This is a lesson number 1 from a 10 course on financial planning. So let's start with understanding what is a financial plan. A financial plan is a forecast of the future financial performance of a business, meaning it is the forecasted profit and loss of a business, balance sheet, and forecasted cash flow statement. Why is it used? Well, a financial plan is used to set goals for your business and guide strategic, operational, and investment decisions. Now, let's talk about the financial planning process. There are 4 main steps in the financial planning process that every business should go through when they start preparing their financial plan. Step number 1 is to identify the purpose of the financial plan. Step number 2 is to define the plan structure, the assumptions that are going to drive the financial plan, and then start gathering data for those assumptions. Step number 3 is building the actual financial model that does all the math and all the calculations for the financial plan. And step number 4 is sense checking the results of your financial plan, whether they make sense or not. So let's deep dive into each one of these steps. Step number 1, identify the purpose of the plan. Why is this important? Because depending on the purpose for which you're preparing your financial plan, the level of complexity for the plan could be different. For example, at one extreme for low complexity financial plan is when you require a financial plan to apply for a bank loan. If you're a stable business that has been running, that has been operational for a long time and has the historical data, applying for a bank loan requires a quite high level financial plan. What you will need is just high level financial statement projections. They need to be sense checked and aligned roughly with the historical performance of your business. And then you should check a few of the main financial ratios that they are again, they make sense and they are aligned with your past performance. On the other extreme is a high complexity financial plan when you are, if you use the financial plan to try to raise venture capital funding. Raising venture capital funding will require a logically linked, detailed, driver-based financial model that drives your financial plan. Then the results of that financial plan need to be sense checked against past performance, but also they need to be sense checked against industry benchmarks, so market and competitor benchmarks. And number 3, you need to clearly present your financial plan so that investors can easily understand it and buy into it. So these are the 2 extremes of low complexity and high complexity financial plans. Everything else falls somewhere in the middle. Now, step number 2, define the plan structure and assumptions. What does it mean? There are 3 sub-steps in here. What is the financial plan structure? Well, this is where you define all the revenue streams that you have, that your business generates. You define all the types of different employees that you need to operate your business, all the operating expenses that your business will incur, the assets that you need to run the business, the financing that you need to run the business, and then taxes assumptions and working capital assumptions. Once you have defined this structure, then you move on to the second step, which is defining the assumptions that will drive these the calculations of all your revenues, expenses, employees, assets, and so forth. So assumptions, for example, for revenues, it will be the number of units you plan to sell and the prices at which you're selling, the number of employees, the salaries per different type of employee, inflation rates, conversion rates, cost per lead. Every business has a different set of assumptions which are relevant to that specific business. So the assumptions have to be specific to your type of business. Now, once you have defined the assumptions that are going to drive your financial plan, then the third step is to start gathering data in order to substantiate and create assumptions which are defensible. So where do you gather data? There are 2 main sources where you should be gathering data for your assumptions. Number 1 is historical company data. If your company has been existing for a while, has been operational, you have data about all your assumptions. So that's always place number 1 to start, historical company data. And second place is to look for market and competitor benchmarks for your type of business, for your type of industry. This you get from different publications, industry publications. You search online, but these are market benchmarks. So that's step number 2. Define the plan structure and the assumptions behind that financial plan. Step number 3 is now actually build the financial model that does all the calculations and all the math to come to your financial plan. So there are 3 kind of sub-steps here. The first part in building your financial model is creating an input sheet. Basically, this is a list of all the assumptions, the drivers, the inputs that you are going to provide to the financial model in order to calculate your final result, your final financial plan, which is the profit and loss statement, the balance sheet, and the cash flow statement. So first, create one sheet with all the assumptions for all the assumptions that you will provide to the model. Step number 2, once you have the input sheet, is to calculate the intermediary outputs. These are your revenues. How do you calculate each revenue? Is it number of units sold times prices? Is it a different calculation? So you need to do all the formulas in order to calculate your intermediary outputs. So your cost of goods sold, revenues, cost of goods sold, expenses, assets, liabilities, capital. Once you have calculated your intermediary outputs, you create your final financial plan outputs, which are your profit and loss statement, your balance sheet, your cash flow statement, and other KPIs and analysis that you might require to sense check your financial plan. Again, this is where you create the formulas to calculate your profit and loss, balance sheet, and cash flow statement from the intermediary outputs. This is usually the most complex part of building a financial plan, because building a professional financial model is quite a complex task that usually people with lots of experience are required to do so. And then step number 4, once you have already built your financial model, is to sense check the results of your financial plan. How do you do that? There are two main ways to sense check your assumptions. First, again, you compare your outputs to your financial plan to your historical financial plan. I mean, if you've seen that your revenue grew 10% every year for the last 3 years, and all of a sudden now in your plan your revenue grows 1,000%, then you better have a very good explanation why your revenue growth rate has changed so much in comparison to your historical data. It's not possible. It's possible that it would happen if you have great initiatives behind it, but you have to be able to substantiate and explain the reason for such a difference between past growth rate and the future expected growth rate. So comparing your financial plan to your historical results is one way to sense check your results. And second way is to compare your financial plan and benchmark it with market and competitor benchmarks. Again, if in your market growth rates of competitors are 10% a year, and all of a sudden you have in your plan you have 1,000%, you have to be able to explain it. If in your plan you're saying that you can acquire a customer, your cost per customer is $20, while market benchmarks for your type of business say that it costs $200 to acquire a customer, you better be able to explain why your assumptions are so different than what is a market benchmark. So that's the sense checking assumptions part. Compared to historical result and compared to market benchmarks. And that's it. That's the process. Just to summarize again, the financial planning process has 4 main parts. Identify the purpose of your financial model, define the plan structure, complexity, the assumptions, and gather data for your assumptions. Step number 3, build the actual financial model with all the calculations that calculate the outputs of your financial plan. And number 4, sense check your results. That's it. That was lesson number 1. We will stick around. Lesson number 2 is around forecasting revenues for your business. Thank you very much, and see you around.